Notice of mortgage payment change. What is this, and what does a sample payment notice letter look like? Hey folks, my name is Chris at Hauseit, based here in Miami, Florida. Today we're going to talk about this interesting topic, especially with mortgage rates and interest rates going up generally. Many of you who are homeowners who have a mortgage already may start getting these letters in the mail, and it'll look like something like this. We'll put a sample up on the screen, and I'm looking at it with you as well. So, it'll come from whichever bank yours is. This is just a sample, but it'll essentially be a letter that details what your current interest rate is. You can see that in this example here, it's an adjustable rate mortgage. It's actually an interest-only adjustable rate mortgage, meaning that no principal paydown is required. Typically for these type of IOs, as they're called, or interest-only ARMs, there's an interest-only period for, say, 10 years, and then after that it becomes fully amortizing for the remaining 20 years to be paid off fully in the remaining last 20 years. So these are usually all 30-year loans. But then you also see the interest payment, and this is really relevant too. People will make light of, hey, rates are so historically low, but you have to consider that, for example, if people locked in rates, a number of years ago, and then now it's starting to float again, as you can see in this example, 2.5% versus 4.5%, it's almost a doubling of the interest expense that is facing. I'll bet this is a small loan, but you can see that the interest expense is essentially almost doubled. So this is important. If you don't remember the exact terms of the mortgage that you have with your bank, this is a great opportunity to review, because it essentially summarizes what your terms are. And don't be afraid. If you did lock in interest only or an adjustable rate mortgage, you probably did so years ago with the intention to lock in low rates to perhaps get a better rate than a conventional 30-year fixed. Those are obviously the same interest rate, typically fully amortizing for 30 years, but the benefit is you have the same interest rate for 30 years, which is great. And a stable payment profile, but the con is that the rates are going to be a little bit higher than you would get with an ARM. So a lot of folks perhaps chose to have an ARM. They say, hey, it's going to be a lower interest rate for X number of years, maybe 3, 5, 10, whatever it might be. For your sort of fixed period, it's going to be a lower and more competitive rate, and then after that it becomes floating. But people think, hey, I'll take my chances, maybe I'll be out of there and I'll sell by then. So for those that haven't, and then their loans are now becoming floating, you're going to start getting these notices from your lender, your mortgage lender, and it's important to pay attention to the terms. So let's go over this example as well. One benefit of many of these loans is they typically have a maximum cap. So even though it probably looked pretty high at the time, so this example is 7.625%, not too far off today, right? But at the very least, there is a cap to it. So it's not like if rates go to double digits, you're going to have like a 12% interest. So you are protected from a cap. And as you can see here, that there's a minimum cap as well. It can't go lower than 2.25%, and then that the change can't increase by more than 2% on the change date. So, and then you also see this. It says that it also tells you here that so as you can see here that the interest rate changes every 12 months. So it tells you when it's going to change again, and it changes. So it's basically a yearly change of the interest rate. It tells you what the sort of the index rate is. So basically what it's based off of. Usually perhaps a LIBOR rate, but these days it might be a bit different. 1-year LIBOR index by the Wall Street Journal. So you can look it up yourself, and then it's LIBOR plus a margin. So in this case, it would be LIBOR plus 2.25%. And because, as you can see, the 1-year LIBOR rate has gone up from quite low, close to 0, to now 2.65%, this is why your monthly interest rate has increased. So we hope you found this article helpful. We hope you found this video helpful, rather. If you have any further questions, leave us a comment below. Of course, if you're looking to sell, perhaps because you want to, stop not have to pay such a higher interest rate these days. It's maybe time to get out. We can help you save all 6% in broker commission with our agent-assisted FSBO listing service. And of course, if you're looking for something a bit more hands-on, we have a 1% for full service listing option where one of our agents handles everything for you for a 1% listing fee. And of course, if you're looking to buy something new and different, we can help you save 2% or more with our buyer closing credit, where one of our buyer's brokers gives you 2/3 of the buyer broker commission, subject to us keeping a minimum of 1%. My name is Chris at Hauseit. We're based here in Miami-Dade, Florida, but we also cover all of New York City, Long Island, Hudson Valley. We cover Miami-Dade County, Broward, Palm Beach, Barton, and St. Lucie counties in South Florida. My name is Chris at Hauseit, and I'll see you on the next one.